Good morning, listeners. I'm Noah Mercer, and you're tuned into the FinMonkeys Morning Brief. We've got a busy day ahead. The Fed just held rates steady, bond yields are giving us a heads up, and AI is still on fire. Let's dive in. First up, the Federal Reserve left its policy range unchanged for the sixth time in a row, signaling no immediate cuts and keeping borrowing costs high. Next, soaring Treasury yields are flashing a warning that the market could feel pressure if rates climb higher. Finally, AI-driven stocks are powering a rally, and OpenAI's quietly filed for a confidential IPO, hinting at a major new entrant to public markets. Analysts are already flagging that the steep rise in bond yields could squeeze equity valuations if the Fed decides to hike again. The Treasury market is pointing toward tighter policy, a signal that higher yields might be here to stay. Those moves matter because they drive the cost of capital across the economy and can tip the balance between stocks and bonds. Even with that backdrop, the AI sector is charging ahead. Strong earnings from AI-focused companies are lifting U.S. equities and even spilling over into European markets, expanding the breadth of the rally. Meanwhile, OpenAI's confidential filing suggests the public listing is on the horizon, which could funnel fresh capital into the AI space and reshape investor exposure. On the earnings front, Asana reported Q1 results that diverge from the broader productivity software crowd. Its performance highlights that demand for collaboration tools isn't uniform. Some players are thriving while others lag. Those patterns help us gauge where the SaaS market's growth pockets are, and they tie back into the larger narrative of a market navigating higher rates and sector-specific momentum. That's the FinMonkeys Morning Brief for today. The next thing to watch is Treasury data and any Fed commentary, plus OpenAI's IPO progress. Thanks for listening to FinMonkeys. We'll be back tomorrow with the next market setup.